Hey everyone, I'm Anita Sharma. Welcome to Market Call tonight on BNN Bloomberg. Our special guest is Jaime Carrasco. He's a portfolio manager at Canaccord Genuity, taking your calls, emails, and tweets on precious metals and North American dividend stocks. Their number toll-free, 1-855-326-6266. Our email address, marketcall@bnnbloomberg.ca. Our Twitter handle, @MarketCall. It's always great to have you on the show, Jaime. We get to dive deep into gold. Gold currently just hugging. It's close to $1,500. A lot of your buddies, a lot of your colleagues in the space are saying if we continue to see hiccups with respect to U.S.-China trade, we could once again bump up over $1,500.
I would beg to differ. Thank you for having me back, by the way. It's always great to be here.
Thank you.
Before we get into gold, I think what's important to understand that the strategy is working. The producers are holding. I've always said that the producers were going to outperform, that we're going to give the leverage. I've just finished doing client reviews, and they're seeing the returns. They're seeing the fact that as this instability continues to move forward, the producers are outperforming, and that 20% that we started with is becoming a bigger percentage of the portfolio, and it's happening, right? The other thing, so I offer two solutions. One is a broadly diversified portfolio, utilities, pipelines, all the blue chip dividends.
Right.
But that has always had 20% gold. The other one's a standalone gold portfolio, which has about 15, 17 stocks within it.
Yeah.
Now that is for high net worth and family offices that needs to take a standalone stake in the sector because they don't have any.
Right.
Now, I'm getting a lot of calls from people that are saying, well, you know what, there's a lot of instability, and I like what you're saying. The other thing that I have to add, and I have to put a plug for Canaccord, because Tom Jakovich, who was a managing partner at BMO, just joined us on the gold team.
Okay.
So on top of that, Canaccord's also lining up early on into what I think is going to be an amazing bull market, because it's about instability. I've always said that you can measure what we're going through just on the stock market going higher. I have always argued that the stock market's going higher because the Fed's printing all this money.
Right.
Look at what happened. It took 2 weeks to unwind. How many months of unwinding the balance sheet, and we're right back up. We've gone up 40% from the bottom.
Yeah.
The repo market, again, the fixed income market, is clearly signaling that the addict of debt still needs it. And they, it was like somebody trying to come off of that addiction, and the money needs to be printed. And because of that, yes, the markets could go much higher. I think we're just going to see a lot of volatility, a lot of uncertainty. And what a better asset than gold for that. Now, Macedonia, there was a list of almost 5 central banks just in Bloomberg yesterday that were stocking up in precious metals.
Yeah.
So, and it's physical. It's not paper. Now, what I find really interesting...
Does that kick in with seasonality, too? Are we also right now in the thick of seasonality with respect to gold?
That would be with regards to India and China, but not when Macedonia and Uzbekistan or some stan is buying gold. I think they're also signaling. Look at Chile.
Yeah.
Look at what's going on with the peso. Every one of my Chilean clients that actually has physical gold that was listening to me 2 years ago is benefiting great because it's at an all-time high. Now, what I think is more important, though, is the fact that going forward, gold, as it starts to move, it's what's happening within the producers. The producers, if we can bring up one of the ETFs that tracks the producers, the VanEck, I think, is the one that we were talking about.
Okay, give us a symbol.
GDX, the GDX. It's holding up very well, right? It's not pulling back the way gold is. Now, that's an important signal because it means that smart money is coming into the producers, which is going to offer the leverage. So if you look at that, at the breakout that we had right here in 2019, it's not breaking. It's holding nicely, right? And that, to me, is very important because what it's signaling, if you look at the breakout in 2016, the traders came off and they came out of the trade. What's happening now is the traders came off at the top, but there's new money coming in. And that's a clear signal that when the next leg starts, it's going to be led by the producers and people are going to notice.
So what you're saying then is, we've got analyst after analyst right now saying that they're not playing defense anymore. They're sticking with the cyclicals, or they're going back to the cyclicals. They're predicting largely because of what you said, the Fed really providing that extra amping the markets with all that liquidity, that we're going to continue to see a bullish scenario play out for stocks, for equities. Now, normally one would think that would have gold pulling off, but you're making the case that the two in concert will rise.
Correct, because I've always argued that all the markets have been I don't want to use the word manipulated,
Right.
but they've been massaged
Yeah.
by printed money.
Right.
Some have been massaged higher, some lower. And at some point, the one that has been held down lower, would people be running into the Dow at 28,000 if gold was anywhere near 2,000 or 3,000? No, they wouldn't. That's the reason why I think gold has had the condition that it has, because the supply-demand fundamentals of the physical that is leaving and has been leaving for a couple of years just doesn't match this price.
Okay, well, I know we're just beginning our conversation on precious metals, and I'm sure our clients, our viewers rather, who are also clients, I'm sure, of other firms, will call in and get you to do some deep dives into gold and silver. All right, past picks time with Jaime Carrasco. Metalla royalty. You were acknowledging that you weren't really watching this closely. You put it in your portfolio and kind of kept moving onwards. Well, in the meantime, in between time, if our viewers had purchased this on January 16th when you recommended it, they'd be up a whopping 72%.
Again, what I like about Metalla, you know, all of these companies are just getting going. What I like about this one is they have all of these projects that are starting to pay cash flow.
Right.
They have acquired more projects. The dividend's increasing. So going forward, what are we going to get? We're going to get upside from the projects that they finance.
Yeah.
You're going to get continued increase in dividend as all of those projects kick in. And on top of that, you're going to get the reserves on the ground value, and you're going to get a dividend increase. So I think it's one that I'm quite happy to hold and let it ride. One of the things that we were talking about, so the portfolio started at 20% this time last year. Now it's sitting at 37, but I haven't cut it back. I haven't done any asset allocation rebalancing because nobody's in the trade yet, right? I want to let the next wave go because I think the wave that's starting now is the one. The first one's always a stealth one, only the ones that are participating. You have new money coming in now, and that money is going to accelerate as we break above 1550. Well, it's going into the producers already. So I think the producers have already kind of taken off or held their position. And I think going forward, I'm going to let that build, and then I'll consider what do we do. And
you had alluded to this at least 2 times, the 2 previous times you've been here on Market Call tonight. You said that when we break above 1,500, and then you came back and when we actually did break above 1,500, you said there is going to be some consolidation. It is going to drop below 15, and then you got to wait for that. For the folks who missed the first go round, they're going to have an opportunity to lock in a position under 15. And so that's kind of where we're treading right now.
Right. If you look at the 5 or 4 years prior to that breakup, that was all patience. Everybody that held on has benefited, and now they're seeing the benefit, right? What's happening now, though, is new money is coming in. New people are figuring out, okay, how can I reposition my portfolio? I'm getting a lot of calls with regards to that. And so even I'm seeing new money coming into the portfolios. I think when the next one goes, you know, that's when the light's going to come on because you're going to see a massive move. Do we get above 1900? We'll have to see, but I think it's going to be pretty explosive.
Okay.
Right? You know, it's important to understand that at the COMEX, on a yearly basis, we are trading more than 6 times all the gold that we have produced throughout the history of mankind. That's a crazy number. Like we're trading more than 300 times annual production. Like, how is that going to resolve? That musical chair analogy that I kept saying, that, you know, the central banks are taking away the chairs, but you're getting more and more people with a piece of paper.
Right.
When the music stops, there won't be many shares left. The producers are going to be the place to get it.
Okay. Also a place to be, many would say, we're not seeing it in your returns right now, though, is emerging markets like India. Fairfax India, though, off by about 13%. What are we waiting for here? Because the long argument against companies that are investing in India is that the promise is there, the luster is there, but for some reason it's really tough to cash in. Is that time coming up soon?
I'm quite happy to hold on to this.
Okay.
I like the whole One Belt Road that the Chinese are building. India will be part of that. India is definitely readjusting itself. You know, if you look at Fairfax, I've invested in this because of Prem Watsa and what he did in Canada over the last 30 years. If you look at that 30-year investment in Fairfax and you're just looking at a little blip, well, you missed the whole ride. I'm quite happy with his stewardship in terms of the companies that are being bought within the portfolio. It's in the financial sector. Again, in India, 5% of homeowners have home insurance. It's a big big market to be had. I'm quite happy to have it. I also think that I like it because, one of the reasons why I like it is the currency. I think as the whole economic bloc of Asia, which I think it's California in 100 years ago, as that starts to take off, all of these financial companies we own within that are going to appreciate. And that's my stake on it. With this one, I use asset allocation. Whenever I rebalance the portfolio, it'll go back to the 5% that it's in the portfolio and take advantage, continue to buy more. So, I'm holding on.
All right, you're holding on, and you're also holding on to some cash as your third pick. Give us 20 seconds on that.
No, that's all spent. It's spent in convertibles now.
Okay.
So, yes.
All right.
So all of my cash, all the cash that we raised last fall has been redeployed into convertible bonds. I've really bought 4 years of time so that I can allocate it later. Let's see what happens to the market.
Let's see what happens. All right, Jaime, let's take a break and get back to our viewers' calls. Jaime is a portfolio manager at Canaccord Genuity. Our phone number, 1-855-326-6266. Folks, we're also taking calls on pipelines as well as utilities. We love the gold calls, but feel free to call in about utilities and pipelines, too. We'll see you in 2 minutes. Yes, time went by quickly, right? So many calls. Jaime Carrasco, so popular. Our market call tonight. Sandstorm Gold, top pick number 1.
A new royalty I've added to the position. I got taken out of North American Palladium, so I had money to spend.
Okay.
I had done my homework on this one. Actually, they're one of the biggest shareholders of USA as well, so I get a little bit more USA.
You're still bullish on USA?
I am. I like the way that Nolan's executing, very well managed, and I think they're just like Metalla and the other royalties. I expect quite a bit of them. It's that leverage. It's the cash flow. And they've been buying back their shares, which is great, right? They haven't started a dividend yet, but they've been reducing their share count, which to me is very important.
All right. Agnico Eagle Mines. We keep hearing about Agnico.
4 years. 4 years. This thing was at $22 4 years ago. Like when everything was still going down, these guys hit bottom and they've been moving higher. They've just increased dividend by 40%. Again, these guys have executed in an unbelievable way. A lot of mines still to kick in, so cash flow will continue moving, producing at 680, I believe it is. So massive, and gold in Canadian dollars is at $2,000. So massive profit. That'll continue to increase the dividend. They've just executed unbelievably, and I still like it and hold it and recommend it.
And you're also recommending Harvest Equal Weight Global Utilities ETF.
Yes,
HUTL.
I was looking, we're going to be taken out of Dream Global.
Right.
That's about a 6.5% dividend yield that I want to replace, and I like this. It's global. I like the portfolio of companies. It's the top 15 utilities. Enbridge is in there, and a couple of Canadian companies, Brookfield. But again, the yield, and I get income from outside of Canada, so it's diversified. And they also have a covered call position within it, which increases the dividend yield. So, and it's Harvest. I like the management, Paul McDonald. Like, if I said his name wrong, I'm sorry. I always have a bit of a blank, but well-managed ETF. I like the guys from Harvest.
I want to go back to Agnico. We've got a bit of time. I want to pull up a 1 year, guys, if we can. Thank you in advance. We did see a bit of a dip, and I'm pretty sure Agnico is playing out like a lot of the other stocks that we've seen.
All of them.
As far as gold goes, right? So you're seeing the pullback from September. This is making the gold bears, if you will, a little
Not at all. No. This is the gold. This is making the gold bears walk the other way. Because look at what's happening here. If you look at gold, it's fallen off from that bottom. Yeah. Right? Somebody's been buying it. Money's coming in, right?
Talking about the bottom of October.
At the bottom of October, gold has kept going, and it broke at in the middle of October. It broke below 1,500. So if you overlay a chart of gold on that, it's one's going the other way, the other one's going higher. So that's signaling that smart money in this run up, it's going to come into there you go, right?
Smart.
It's a little bit askew. If you actually do just October, you'll see the difference. However, the important thing is that signaling to me that new money's coming in because this is one of the best companies to own.
All right, so this is folks basically building their position ahead of what you see as turmoil going into 2020. And once again, your thesis isn't that we have, they're not going to run mutually exclusive of each other.
No.
We could have a bull run in equity markets, and alongside that, not see gold
Correct.
continue to rip.
Correct.
Okay. We're out of time. Jaime, we could spend a whole week chatting with you. It's
Thank you
always
for
a
having me
pleasure.
back.
Jaime Carrasco. I'm Anita Sharma. On behalf of our senior producer, Aaron Sabeski, thank you so much for watching. Stay warm and always consult a qualified financial advisor, folks, before you make any investment decisions. We'll see you tomorrow, 12 o'clock Eastern, and then again, 6 o'clock in the evening. Take care.